What's up everyone, it's Caddy with MoneyVest. So in today's video, we are going to be talking about the upcoming week here. We've got a very packed last week for the first quarter of 2024 in front of us with a lot of earnings, including some economic data as well as Chairman Jerome Powell's speech. And I'm going to be going over how the markets are priced in terms of valuations and technicals and some of the other updates from analysts as well. As always, if you enjoyed this video and find it helpful, all I'm asking in return is that you drop a like and subscribe to the channel. I would really appreciate that, and we're really trying to hit 200 likes on this video. So let's see if we can at least get up to that level, and links to our Discord and Patreon is going to be down below. There's a few more spots left for the month of March, and you do get a 16% annual discount available until the end of this month. And of course, along with that, you get access to all of our TradingView charts and alerts and watch list, including our trade ideas and options alerts, as well as the moneyvest.com website and the weekly newsletters as well. So links can be down below. Would love to have you on board. And if you have any questions, feel free to reach out. Now, coming over to the earnings, we are again slowing down in the number of companies reporting earnings, and the important companies have already reported for the fourth quarter 2023. We are actually going to be getting started with the earnings season again in April. We've got started with Tesla is going to be the one that's reporting earnings very soon. And we also are going to be looking at Tesla's first quarter deliveries that are going to be coming out in the first week of April. But next week, so this upcoming week, Friday, by the way, is a holiday on the back of Good Friday. But we do have, earnings related to GameStop coming up on Tuesday after the bell. We've got Encino. This is another stock that's been on my radar and my watch list. It is a financial banking and fintech stock. Then we got Carnival Cruise Lines. We got Rumble. We've got RH. We've got Paychex reporting, Cintas reporting. So this is all going to be on Wednesday, pre-market or aftermarket. Thursday, we've got Walgreens Boots Alliance. So WBA is also going to be reporting. We got Hut 8. And then, of course, some of the other companies like Planet are reporting on Thursday after the bell, and then no companies reporting on Friday. Now, if you come over to the economic calendar, so starting on Monday, we've got the Raphael Bostic speech. We've got the Lisa Cook speech also coming up. And then if you take a look at Tuesday and, of course, Wednesday, we've got the Case Home Schiller Price Index. We've got the consumer confidence numbers coming out. We got Christopher Waller talking on Wednesday at around 6 p.m. Eastern. And then we got the MBA mortgage applications, the 7-year note auction, the 2-year note auction, and the 4-month bill auction as well. The GDP numbers on Thursday at 8:30 a.m. Eastern, along with the jobless claims that come out every Thursday. The Fed's balance sheet is going to be on the very same day, along with consumer sentiment. And Friday, even though markets are closed, we do still have personal income and outlays and the very important Jerome Powell speech, for which I will be live to cover that at 11:30 a.m. Eastern. That is basically going to be a discussion, moderated discussion with Kai Rizdal at the Federal Reserve Bank of San Francisco Macroeconomics and Monetary Policy Conference. It's going to be in SF, California. Discussion, Chairman Jerome Powell as well. So that's going to be 11:30 a.m. Eastern. I'll be live to cover that. So that's basically what is coming up in the market. So this is quite an interesting chart between the CNN Fear Greed Index and how the markets have performed or really done after the Fear Greed Index showed any type of greed. So basically the green line is the CNN Fear Greed Index and the red line is S&P 500. And what they have basically pointed out to is that every time the Fear Greed Index gets to above 80 index, in other words, it's an extreme greed, we have seen the markets roll over. So this right here are essentially indications for when we saw the Fear Greed Index above 80, and this black one is basically an indication that markets have sold off when we approached extreme greed. So this right here, again, a couple times we saw that sell-off, a little bit of a pullback here, and right now we're once again at these levels, and the market continues to rip higher and higher. So we continue to move up, hitting new all-time highs. So just got to be a little bit too careful here because of the euphoria and the greed in the market in the past. As we have already discussed, a lot of these indicators are there for a reason. They give us an idea, give us a sense of how the markets are priced, how the valuations are, how the technicals are, and we have to account for all of that in our decision making. Just because the markets are going higher doesn't necessarily mean that we can just simply be aggressive and be buying and expect the markets to keep going higher, because eventually it all comes to an end. Everything in life is temporary, right? The only constant is change. So we have to understand the markets are indeed cyclical, and they move in these cycles where they become overbought, oversold, overbought, oversold. We go from extreme fear to extreme greed. We go from fear to neutral to greed. We go from greed to extreme fear. So it's just that cycle that keeps on happening over and over again. And once you understand that, your thought process will change. Instead of saying that, oh, the markets can keep going higher and I need to buy here, you'll be more like, okay, I need to be cautious and start de-risking or start lighting up on some of the positions to raise more cash so I can deploy when there are better opportunities in the markets once again. Or you could simply be dollar cost averaging every week, every month, depending on your situation, and not really care too much about the cyclicality of the markets. That's also a very, very profitable and very consistent way of investing long term if you're simply dollar cost averaging into broad-based ETFs. And that's what I do with VUG, that's what I do with SMH, simply buying and holding and dollar cost averaging into those ETFs. Now this right here is a technology sector which continues to outperform S&P 500 beyond any level ever experienced before. So this is again standard deviations, and we are right now +2 standard deviations for technology's performance relative to the S&P 500. So you can see significant amount of momentum coming in for technologies, right? So bull leadership since the great financial crisis in 1966. We saw that very similar thing happen, and then that of course followed with a pretty significant sell-off. This right here was a dot-com bubble, saw a pretty significant pullback here. In 2006, 2008, we didn't really see any extreme levels for technology, and as a result, not a significant pullback, relatively talking. And right now, we are at an extreme level here. And I did a video yesterday going over individual sectors. So we went over all S&P 500 11 sectors, their valuations, and their technicals as well. So make sure that you do check out that video. It's almost a 30-minute long video that I took a lot of time in producing and kind of putting together. So again, make sure that you do check that out so to get an understanding of what sectors are appropriately priced, reasonably priced, versus which sectors are somewhat trading at an expensive valuation, and technically speaking, which ones are overbought, which ones have the momentum going for them. But just keep a close eye. It doesn't take too long to get that rotation out of tech over other parts of the market, because as the markets have already taken staircases up and always elevators down. This right here is going to be the S&P 500 trading at a 25% premium based on its next 12-month price to earnings multiple compared to S&P equal weighted index, right? So this right here is going to be S&P 500's equal weighted index, which is trading at around 17 times earnings, compared to the actual S&P 500, which is SPX, trading at 21 times earnings, which obviously is a little bit of a premium. And this divergence, this discrepancy also happened, if you notice, back in the 2000s, right, when there was a dot-com bubble. And after that, it has mostly been together. It's mostly been somewhat similar. You can see that both lines are moving in tandem with each other. So valuations are somewhat, appropriately priced. In other words, they're both trading at the same level. Even prior to the dot-com bubble here, we saw that, togetherness between the S&P 500 and the equal weighted S&P 500. This right here was the big divergence here, where the valuations for the S&P just got out of hand compared to the equal weighted index. And that is simply telling us that, okay, technology was the one that was driving this momentum higher, because again, that was a tech bubble, that was a dot-com bubble, and we did see that divergence there between those two indices. And right now, if you notice that we are seeing something somewhat similar, so that right there is the valuation gap here, and you can start to see that, okay, both lines are moving up, but one of them is moving a lot more aggressively compared to the other, right? So S&P 500 just becomes a little bit more concentrated and becomes a little bit more tech heavy as it continues to move higher at these levels, at these prices here. Now, coming over to some of the expectations in terms of targets, there are another analyst here from Goldman Sachs saying that mega cap bull case might take S&P to 6,000 as well. So yuan slides past closely watched level of 7.2. So this is the yuan relative to the USD. We've talked about the trouble trifecta. So if you come over to our analysis, we've talked about the dollar index, which again, DXY, very, very important, mostly been consolidating here. We've talked about the 10-year treasuries, the yield here, 4.2% right now. A little bit consolidation at that level. So we did see a rally back in the first couple weeks of March, and then 4.35%, very, very important and critical level to watch on the 10-year treasuries. The only way I really see the S&P getting up to 6,000 is if the 10-year treasuries and the 10-year yields starts to basically roll right back down, and we're looking at 3.25% again for the 10-year treasuries, as we were back in April of 2023. And more importantly, we see crude oil prices start rolling over, right? So crude oil prices have been ripping higher. So this right here is the entire momentum for crude. We are seeing a lot of, rally here in 2024. If you get another breakout to the upside, the next target is going to be $93, $94, which obviously is not going to be great news for crude oil and inflation. Because at the end of the day, the Federal Reserve is really looking at inflation to better judge and assess what needs to happen with interest rates. So very, very important indicators here with respect to crude oil and of course the dollar index and the 10-year treasuries, and more importantly the volatility. Now the reason why I didn't go over volatility in my yesterday's video is because I wanted to spend some dedicated time on the VIX, and as we have already discussed, that this is a level where I think one needs to be cautious and alert that okay, if you do see a spike in VIX, that can lead to a potential pullback or a dip or a correction in the S&P. Just because the VIX is low does not mean that we can start selling, or we can start selling short and we can start buying puts. There's a huge difference. But when the VIX is high and it is trading at, let's say, inside this green rectangle or even higher levels at as much as 36, 37, then of course it becomes a little bit of a challenge, because a challenge from a perspective of the markets selling off, because when the VIX is high, it's most likely the markets are selling off. We're seeing a pretty significant selling pressure, correction, pullback, whatever the case may be. But the good news is that that represents huge buying opportunities. That represents actual serious buying opportunities, because historically, every time the VIX has gotten up to certain levels, we have seen the markets sell off, down maybe 15%, 20%, 10% from their all-time highs. And that has almost always, in fact, not almost, it has always been a buying opportunity since the markets are trading at all-time highs. So let me just put it another way. With everything that's happened in the world, everything that's happened in the market, everything that we have thought about, all the possible outcomes, all the possible scenarios, every single bearish thesis that you can think about in the market, on Twitter, on YouTube, everything, like all the thumbnails, all the titles, everything that you've read, just think about that for a second. All that was useless. Why? Because markets are at all-time highs. Markets, S&P 500 being at all-time highs in itself is a huge middle finger. I would say, apologize for that, but it's a huge middle finger for all the bears and all the short sellers and all the people that have a narrative of markets selling off, right? Everything, like literally everything that we have discussed, or whoever's discussed, let's say 2 years, 3 years ago, or is discussing about the market, does not matter, because markets are at an all-time high. Okay, so every volatility spike, every recession, earnings pullback, or whatever the case might be, any type of inflation update or interest rate, I mean, all of that has really been useless from the entire media, from everybody, because markets are at an all-time high, right? So markets will do what they want to do at the end of the day. Like that's really what it is. And as I mentioned before, staying in the market, staying long in the market is by far one of the best, more successful, more predictable, and proven strategies in the world of investing. Shorting, buying puts, it has never been successful, at least not consistently. Okay? So it's really, really my recommendation to myself. If you want to take it upon yourself, please be my friend, but do your due diligence on this as well. It is really important to make sure that you understand that just because the VIX is low does not mean that it's time to start selling and start shorting. It really is an indicator to use when the VIX is high. When the VIX is high, those are serious buying opportunities for the market. And that's why you'll notice the short interest as a percentage of shares outstanding has gone down significantly. So shorts are awfully quiet here because the markets continue to push higher, and they have just destroyed a lot of the short sellers and the bears here. Equal weighted index also at an all-time high, so that is really good. That's what we're seeing. We're seeing a broad-based rally, which was also discussed in our yesterday's video, as the S&P 500, 11 sectors, all of them seeing a lot of momentum, seeing a lot of progress in the last few months here. And this was a very interesting chart put together by one of our members. And basically what this shows us is the number of companies year-to-date return. So what we are seeing is how many companies are making new all-time highs versus how many are still below 10%. And I believe this is S&P 500 if I'm not mistaken. So 0 to 5%, basically 0 to as much as over 20%. If you do the math, we're looking at 96 plus 89 plus 78 Let me just do that, and plus 17. So we're looking at 280 companies that are now positive on a year-to-date basis, and 96 of them are only down between 0 and 5%. So that's about almost 400 companies out of the 500 companies in the S&P 500. So over 75% of the S&P 500 is basically up on a year-to-date basis or only down between 0 and 5%. So that again is a very strong market, broad-based rally, broad-based momentum that we're seeing in the market. What's really happening is the rate of increase in technology is significantly more than the rate of increase in other sectors. So while we're seeing a little bit of a broader market rally and broad-based momentum here, it's still getting concentrated because the rate of increase in tech is significantly more than the rate of increase in other parts of the market and other sectors here. So that's where we are. What I'm telling myself is basically that this is a time to simply hold, sell calls, take advantage of the gains here, do nothing basically, right? And then the markets, when they do start pulling back, let's say that we get a pullback or correction or whatever, volatility spikes, then that's going to be a serious buying opportunity for myself. I'll start deploying cash. So basically, patience is going to play a big role. We have to let the prices come to us. We have to let for better and better deals. And until then, just enjoy the ride, holding strong, selling calls, and taking advantage of these gains higher. So as always, happy investing. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. I'll see you guys in the next video.